Hello and welcome to the Real Estate Macro Podcast. I'm excited to have my friend BD on. BD, can you introduce yourself?
Yeah, thanks for having me here. Um, um, my full name is Badawi Fuad, but I go by BD for short. I guess I am right now a real estate fund manager as far as my full-time job, where we focus on grouping our capital with other investor capital and deploying into a project that gets actually really good returns, like 2x returns within 5 years, and mostly in the commercial real estate value add space.
And BD, you did not start in real estate, which I think is really fantastic about your background. Actually, have a significant tech background to kind of set the stage.
Indeed, Doug, actually, I started my career as a design engineer at IBM
Hmm.
after I finished my electrical and computer engineering degree. And it was a fun ride. And I really enjoyed tech. And I would say won't do it any other way. I've always enjoyed tech, but over time, just kind of randomly got into real estate by coincidence, and I have a good story for you there. How I kind of got into real estate,
Yeah, I'm
and
fascinated. How did you like? Oh, wow. Okay, let's go down that road.
yeah, so let's go down a little bit of memory lane here. So started at IBM, really excited, finished college, you know, working on designing circuits to basically test the memory. You
Mm.
know, when you're designing a memory chip, you want to make sure that you stress test it before you ship it to the customer. So we were building all these circuits to make sure that we write it thousands and hundreds of thousands of times and then reading it and make sure it's good memory before we ship it out to a customer. So when people ask me, it's like, hey, what do you guys do at IBM? I said, I fry chips. My job is to fry.
I'm just trying to blow it up. I'm not trying to make that circuit board scream. That's
That's
right.
right. Yeah, I'll tell you that didn't go very well with the ladies, frying chips.
They're like, what?
Yeah, exactly.
Yeah,
Well, maybe a couple of MIT chicks got it, but
yeah.
that's about
That's about
it.
it.
But
Yeah, yeah.
and
That's
then
about the point when I'd lie and say I'm a spy for the CIA.
KGB.
Yeah, I'm a KGB agent. Don't worry.
So funny part is when I started my work at IBM, my first week, my manager comes to me and he's like, "So where are you living now?" Because I had to relocate from
Hmm.
Boston to Burlington, Vermont, to start work. And I said, I rented a 2-bedroom apartment. He's like, "Oh, no, 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 no. I'm gonna call my agent. She's gonna find you a house. You're gonna buy a house." I was like, "Okay." I had
Wow.
no idea.
Yeah.
I had no idea. He was awesome. He's a first generation immigrant. He went to the
Hmm.
same school as I did, alumni of the same school. We met actually on campus recruiting, and we really
Nice.
connected. Really, really awesome guy. So, I go to his agent. She shows me 3, 4 houses. I was like, okay, I like that one. She's like, do you know how much you want to buy? I was like, I don't know. I know nothing. I know nothing about mortgages. I knew nothing about buying. So she was really awesome. Like I had an awesome team to guide me there with mortgages. As a matter of fact, up till today, I still remember the mortgage lady. She said, "You are my youngest client." I was like,
That's
wow.
so awesome.
And it was like, okay, college grad, a W-2 income, fairly stable. And yeah, I just ended up buying that first house. It was like a 3-bedroom townhome.
Yeah.
And I was like, okay, it's too big for me. I only need 1 bedroom.
Yeah.
I'm just like finishing being a college student, right?
Yeah.
Just starting my career. So I rented out 2 rooms to a couple of friends, and their the rent payments that they were paying me every month covered my mortgage. So I was pretty much living, they were basically paying my mortgage, and I was living rent free. And that was kind of like my first intake into real estate. I was like, wow,
And
I
that
had
was
no idea.
definitely before it was like, before bigger pockets, before anything, you were house hacking, before house hacking was a thing. Yeah.
Yeah, I kind of stumbled into house hacking by coincidence. Let's put it that way. That was really my intro into real estate. It is pure coincidence.
That's
Um,
incredible.
Needless to say, when I was doing the math, I was like, okay, I'm paying for rent 650, but if I buy this house, my mortgage will be 550, including tax and insurance. And so it's actually at that time in that submarket, it was actually cheaper to buy than it is to rent. So the economics made sense, and then all of a sudden I'm living here rent free. So let me tell you, I had a good life. I bought myself a nice car and a whole lot of toys
Yeah.
and snowmobiles and you name it. Um, but again, it was it wasn't until like a few years after that I really realized that, oh my God, the house is appreciating. And then the mortgage person called me. He's like, oh, rates are down. Let's do a refi. So I go to do a refi. She's like, hey, by the way, you have quite a bit of equity right now because the value of the house went up. I was like, I only put $5,000 down.
Hmm.
You know, she's like, yeah. She's like, would you like to pull out the equity and use it to buy other stuff? I was like, sure. So she did that. And it was just like, honestly, it was by pure coincidence. It's not like I had a father here to kind of teach me how it goes, or
Yeah.
I just kind of figured out by coincidence. And and you know how it is. Like if you're an engineer, you know enough about math to
Yeah.
be able to run scenarios
Yeah.
mathematically, but somebody have to kind of show you how you should really look at it.
Like a
So
context. It's like the math in the abstract is not really interesting. It's interesting, but until you get the context of like, well, let's do the math in this and the mathematics of what how we shall we say tax free withdrawals because you're refinancing out equity. It's like, ooh, that can get pretty fun pretty quick.
exactly. So it was really sorry, fascinating uh to to like almost experience all of that. And I wasn't really focusing on real estate, but I was just like, okay, I spend very little of my time here, but yet it actually, the amount of appreciation it had and the money it ended up putting in my pocket was more than my work at IBM. I mean, granted, my
You're
work at
like,
IBM, was satisfying, paid the bills,
yeah.
and gave me a whole lot of other toys. But it's just like, wow, it's just very different, and then there's no tax to it.
Mm-hmm.
So it was quite fascinating. Um, you know, and then from IBM, I moved back to Boston, started getting into startups. That was really the time to get into startups. I would say in the late '90s.
Mm-hmm.
Caught the whole .com.
Oh,
You know,
nice. Yeah.
yeah. So that was a fun ride. Worked at a startup. We went from 0 to 20 million in sales down to zero.
Oh,
You know, so we all thought, we're going to be millionaires by the time the company hit 20 million in
yeah.
sales. We're going to get caught. And that was about 2001.
Yeah.
And let me tell you, it's just how quickly that money goes away. The stock options that you have on paper that are pretty much worth nothing.
And for those that
So
didn't, for those that are playing along at home, we called it dot bomb. Unfortunately.
exactly. And so yeah, I got to experience that as well. Like, okay. So we tried the startup path. Yeah, a lot of paper potential value, but then doesn't really materialize.
Yeah.
But real estate kept being consistent. You know,
Yeah.
real estate just kept being consistent, and it's just like I'm not putting much time into it. So it's purely by coincidence. Um, then realized that what I'm spending less than 5% of my time looking at real estate, and yet it's contributing about 95% to my wealth
Hmm.
versus 95% of my time in tech. And yes, it does pay the bills, but that's all what it does, maybe contributing 5% to my wealth. So all of a sudden I was like, something is off with this formula here.
Mm-hmm.
So maybe since I like tech and I enjoy tech, and I'm going to focus on making money in tech and figuring out how I'm going to invest it more and more in real estate. And that's kind of where I started the financial literacy journey.
Mm.
Just trying to understand, hey, what could be done and what does it take to actually invest in real estate, and it's like you have to try things to really understand them. I mean, yeah, you can sit there. Maybe right now there's a lot of YouTube videos, but at that time there wasn't a tremendous amount of content out there like it is today. But you
There
ask
really
this.
wasn't. I mean, not until, geez. I was fortunate in undergrad. I was able to actually take a real estate class finally that taught me about commercial real estate. I think you might remember the guy Cardland Sheets that had that late night infomercial. And that was about it, really, in terms of actual formal education that I could find.
Yeah, and yeah, and at that time I didn't even have the dreams of getting into commercial real estate.
Mm.
And I was like, okay, that's a whole different field.
Mm-hmm.
I was like, okay, maybe at best, maybe I'll own about 3, 4 houses and I rent them out, and just generate income that way and have them go up over time. That was really kind of my thought process. And then I stumbled against, like BRRR, and it does work, but it's just honestly, it's extremely, it's not my cup of tea. You
Mhm.
have to deal with contractors and they never show up on time, and you know, having to pick the fixtures and too much details. I'm personally not interested in.
Yeah.
I was like, I'm not into the whole fixing part.
Yeah. Well, I think that's
So
important too. That I think that really kind of underrated part of real estate too. You also have to find the part of it that suits your personality, and I think that's a great observation.
exactly. And honestly, like the best way is go try it.
Yeah.
Don't go big on it. Go try it once, or find partners that are doing it, and you're like, hey, can I give you free time? Can I be a value to you where I'm giving you my time? You tell me what you need to get done in your real estate project, and I'll do it for you for free. That's actually the best way to learn, not even on your own dime. And so yeah, you try to go different things, and I was like, you know what? Yeah, I kind of enjoy this whole passive investing a lot more, and that's kind of how I got a little bit more into syndications. I'll tell you the first syndication I went in. Numbers at a PowerPoint level looked amazing. Um, but then, having to go and wire that $50,000 wire, you're like, is this a real person? Is not a real person? I didn't have the know-how to kind of go and vet a
Mm.
sponsor and go kind of figure out. So I was like, okay, I'm going to take a leap of faith. I've already talked to them. I already talked to a few other investors. Everybody else is doing it. What the hell? Let me take that leap of faith and do it.
And BD, where was this along your journey in investing? When was your first syndication?
That was in the late teens, actually,
Okay,
in the late teens.
great.
Um, I've actually done, prior to that, maybe I have kind of skipped here. Uh, I did a lot of short sales
Mm.
where I've actually, acquired, we rehabbed some, I kept some, I end up selling. I wish I had never sold,
Mm.
especially in the 2010, 2011 was just like
Oh
incredible,
man,
especially
crazy
here in
deals.
California. Because I moved to California in '06, got really busy from like, up until 2010 with the kids and everything else.
Yeah.
Then I had an unfortunate, health bump
Mm.
along the way in 2009. Started figuring things out about 2010. I was like, okay, let me start going back, putting more money into real estate, continue my tech career, continue what I'm doing, but put more money into real estate. And that's kind of where I, jumped on short sale. One of them actually I still have right now. The condo is a short sale that I bought, and right
Mm.
now I don't really. I'm so emotionally attached to it. I turned it into a short-term rental
You just
just to
couldn't let it
try,
go. Yeah.
out what is STR look like. Is that
Mm.
something I want to scale up on or not? Like I said, it takes sometimes for you to try things to decide you want to do it or not. So try it, go small in it, see if you like it before you decide to scale. So for me, I'm a very hands-on. I like to kind of experience one thing. So when I turned this particular condo into STR, I went figured out every software that people use, almost like if they have 50 different STRs, and
Hmm.
how to go and do dynamic pricing for per night. But it was incredibly fun to actually go figure out all these things. But enough for me to know that, yeah, I don't want to really
Not
scale that
really
kind of
feeling
business.
that particular model. Yeah.
Too much too much having to deal with people emotional needs.
Yeah.
Oh, the toilet seat was loose. Oh, the
Yeah.
if you think having tenants is bad when
Oh,
you have to deal with like toilets and tenants, let me tell you, having STR is like about 10 times worse.
oof.
So so for those thinking about creating Airbnbs, let them set their expectation. There's definitely a lot more work
Yeah.
than even just renting a flat out unit.
Yeah. Higher returns probably than long-term rentals, but also higher headaches. So
Indeed.
yeah.
The fun part is while I'm doing all these like different trials in the real estate, I'm actually working on really cool stuff in tech. For example, I worked on the first chip that went into the ebook reader for the Amazon.
Oh,
The first
nice. Yeah. Yeah. The
yeah,
fire. Yeah.
yeah. The first no, the first ebook
Fire
reader.
reader. Or, yeah. Yeah. I'm trying
Not
to
even
remember.
the
Huh.
the first. It literally came out in 2004, 2005.
Oh, wow. So it's way back then. Okay. Yeah. I don't remember
it,
that.
it it's the one that uses e-ink technology actually, and
Wow.
really cool stuff.
Mhm.
It's the one that once it sets the text on the screen, there's no backlighting, so it shuts off the power
Oh,
and the screen
interesting.
stays on. Yeah,
Yeah.
yeah, the very, very old school stuff. Worked on other chips that went into iPhones, into Galaxy phones, stuff that went to DSLR cameras. And that's kind of where my career at some point, start getting promoted. So you're like flying to Japan, meeting
Mm.
with Canon, flying, meeting with Nikon, meeting with, it's really, I've enjoyed actually that part. And up to the point, like for example, we were on the whole Oculus thing. So the first generation VR, just
Hmm.
as the industry was just starting it before Facebook acquired them, just as the industry was just starting with this whole VR. So you're always like on the cutting edge of the next thing yet to come. Some things pan out, some things don't. But so it was a fun ride for sure.
And and so I think you make an interesting point, BD. Some people just they cannot wait to get out of the W-2. But I think what's interesting, as you discovered, just because you were doing the real estate, you had the option to leave, but you didn't have to, and you loved what you're doing so much. It was like, hey, the real estate's there and it's always there, but you love the W-2 stuff so much. It was like not motivated for that reason. And that's really a great point. Not
Yeah.
everyone's going to want to just leave. Depending on what you're doing. This sounds like a fantastic and intriguing career that you've had, and then eventually you got into doing some retail stuff, which was really one of my favorite parts of what you've done. Just really such a fascinating. Can you tell us a little bit about how you found vacant triple net freestanding buildings and were able to re-tenant them, and really, really nice play.
Yeah, no, I'm just gonna dive into that, but I'm gonna show you kind of with a segue where I've decided I've kind of had it with high tech and I want to go focus on real estate.
Sweet.
And it wasn't until 2019 I hit another health bump,
Mm.
you know, and that was 10 years later after the first health bump. But I was like,
Mm.
okay, the first one we passed it, the second one, here it is, and now we're back in good shape. I
Mm.
am not sure what the third one is going to be like. And what people don't realize is, the tech work is quite, intense. You're
Mm.
traveling, changing time zones, meeting, you're literally working around the clock. And and in some sense, even though you enjoyed it, but you don't really realize how much toll on the body that takes.
Mm.
So I kind of said, okay, I'm changing my lifestyle. I want to focus on me, as in my health, my workout, my food. Kind of go back to the basics, and then if that means I have to quit my job, I will quit my job, and then and then go figure out how I'm going to restructure my financials and restructure my life so I can move on without having the need of of an actual income from a job. And that was the segue where I was like, okay, I always looked at real estate. I've always enjoyed real estate. I've always built a lot more wealth in real estate. I mean, tech was good in terms of, paying the bills. But again, when you talk about building wealth, you need something that's consistent. I mean, along the line, I've invested in angel and startups, a couple of friends' startups, but nothing really panned out like
Mm.
like real estate does. So it was always like what intrigued me was that vehicle that was consistent.
Mm.
Um, so that's
And
really
real
from
quick, BD,
2019.
I want to get this on the record too, because I think some people don't, they're not really sure or don't understand the differences. Can you tell me what do you think are the pros and cons of venture capital? You're very uniquely situated to comment on VC investing versus real estate too. I know we've got so many different things I want to talk to you about, but I'd love to get your commentary on why VC is great or not for certain people, and why real estate, in most cases, I believe, is a much better outcome.
Yeah, I mean, honestly, the way I look at it might not necessarily be how other people view it, but the way I look at it is VC investing is about, hey, look at some money that you absolutely do not need, and go roll the dice on it.
Yeah.
It's almost as like, okay, put it on number five on a roulette table and wait and
Yeah.
spin. It might hit, and you're gonna hit a lot of money, or most likely it's gonna bust.
Right.
And then they're like, okay, instead of maybe putting, $10 on number five, break it down into $1 and put it on 10 different on five different numbers. or 10 different numbers. But that's what VC investing. There's a very high chance of no success. But then if it hits really, really big. And then what we were doing was actually angel investing, which is even way higher risk, but way higher return, where we're basically funding a seed for a
Mm,
startup
yeah.
that has not even yet went to VC funding.
Yeah.
So that was even a way higher risk. And it was fun. We liked the founders. We liked what they were doing. We thought, and sometimes it hits, sometimes it misses. But I would say it misses a lot more than it hits.
And it almost feels like angel investing is just almost like you like the people so much you're like, hey, we're going to give these really sharp people a shot at this and see how we do. So I do see that aspect of it. It seems like that'd be a lot of fun, but when it
Yeah.
comes down to investing, I think you're right. It's like you got to make sure that's like it basically pretend the money's already gone, and then we'll be lucky if it comes back.
Yeah, I think there's a whole art for VC investing, especially if you go find where the bigger VCs are and try to kind of, it's like you look where the shark is swimming and you're that little fish that's swimming along the shark.
Yeah.
Yeah, maybe you can make it. Every once in a while, the shark would turn and they would absorb you.
Yeah.
But to give you just, not to steer away from real estate, but it was fun to do like real estate. I mean, fun to do VC investing, especially hearing pitches and so forth. Especially when I myself was in three startups as well here in Silicon Valley. And I'm going to say that one failed. That one of them succeeded, and the exit was acquired by Cisco at the time. And I would say for employees, we made okay money. The founders made significant amount of money, and the investors made a lot of money. So it was quite interesting just to see. It was like, oh, so the investor made more money than the employee. It's kind of interesting. So there are cases when you as an investor make money into into a startup investing. Uh, but kind of going back in 2019, I was like, okay, I really need to go back, relook at my life, understand where my priorities are, which is my health is number one, and everything else goes after, and restructure things. And that's kind of when I said, okay, I really like real estate. I want to go full blown in real estate. I've already been investing in syndication at that time. I've already even had other friends that work with me in tech. They say, hey, can you point us out to where you're investing in syndication so we can invest? So I was already kind of doing that. I already kind of got into the habit of, okay, how do I analyze deals and how do I actually screen operators and so forth? So I said, okay, let's go back. So I went in, I took a commercial real estate investment training, and I got my certification in that with CMRI.
Oh, nice.
And and then I actually found a mentor who was actually a fund manager and in some sense the coach in everything that I wanted to do, because after you get the training you understand how things are, but you don't yet really know how to put properties under contract and how to actually transact a whole full transaction, right? And buying commercial properties is not like buying residential properties. It's very different.
Yeah.
And that's why having a mentor in the early on stages really helped. So with my mentor, we started basically uh, getting into commercial properties, ideally single tenant building, which is the part that you wanted to talk about.
Yeah.
And our goal was always to take them vacant. We wanted to find, hey, where are single tenant commercial retail buildings that are vacant, especially in like, decent sized cities, high traffic numbers. You look at the street, it's going to say, 25,000 VPD, vehicles per day. Big intersection, San Tomas and El Camino. I mean, I don't know what's an equivalent in your area, but, major street intersection. And then once we identify that building, we would actually go and put it under contract. Let's give you an example. Let's say we end up negotiating the contract. It's a vacant building, so most likely it's going to sell based on the appraised land value plus whatever the appraised building value, which is typically not much, especially if that building is 20 plus years old. Effectively, that building is almost worth zero at that point from a commercial standpoint. So let's say we put it under contract for 600K. We start doing our due diligence. We find out, okay, what is the rental income potential for this commercial building? So we start speaking to brokers and everybody else. Let's say that we find out that this building would lease for $60,000 per year. So 60K per year plus triple net. And what that means is the tenant will pay us $60,000 a year. The tenant will pay the taxes, the tenant will pay the insurance, and the tenant will pay the maintenance on the building. So that's the net, 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 right? So the
Yes.
tenant will basically pay us 60K net into our pocket, which is effectively like in multifamily, that's the NOI, right? That's the net operating income. So let's say that we find out that this building would rent for 60K plus triple net. Then we're like, okay, who would be the type of tenant that's interested in this? And then we focused on specific niche, actually. We focused on single tenant commercial retail for quick service restaurant, for QSRs.
Mm-hmm.
So those are like the drive-through restaurants. Think about it is McDonald's was there maybe 20 years ago and they left, or Wendy's was there and they left. So now the owner of that building is in distress because he's having to pay the insurance, he's having to pay the tax, and it's not easy to go back and get another McDonald's.
Mm.
So we buy it from him at 600K, and we go find a tenant to backfill this particular property. Sometimes it could be a restaurant owner that has already 2 or 3 other restaurants. They're looking to expand or they're looking to relocate, especially if it's already a QSR, if it's already a quick service restaurant, a lot of the infrastructure is set up for a restaurant. So to switch it to a bank becomes much, much harder, would require a significant amount of improvements. We call that TI, tenant improvement.
Mm-hmm.
So what we do is we usually like to replace like for like, meaning if it used to be a restaurant, let's try to keep it a restaurant and let's try to backfill it with a tenant. So we'd find like maybe a local guy, a Mexican restaurant that, is successful, likes to expand. We sign a 10-year lease agreement with them. We have them provide us guarantees. We look into their financials. They provide us that they have the financial means to pay that lease. And that lease usually is going to be for 10 years long, and they have options to renew. And it includes escalation. Escalation means every year it goes up by 3% or whatever CPI is, whatever inflation is. So once we have that lease in place, now we have a vacant building with a tenant ready to go start in this building. The tenant's going to say, okay, I need some money. I need some money in order for me to get into this place. So that's usually called tenant improvement, TI. So we said, okay, how about we give you 6 months of no rent, for you having to do whatever type of work, whatever type of rehab to get this restaurant up and running. So for us, it doesn't really cost us anything because we own this flat out right. Because when we go acquire the property, we bought it flat out right. They're already paying insurance, they're already paying the maintenance, and they're already paying the property tax. So we just give up basically 6 months worth of rent, which is equivalent of $30,000 in this case, for them to really put money into the property, rehab it, get it up to shape so they're up and running. Once the tenant is in for a year, we call it seasoned. Once the tenant is in for 12 months, now we have 12 months or 18 months of the tenant basically paying the rent on time. This is the time when we go to the bank. We're like, hello, Mr. Bank. Here we have a property we own outright. We have a tenant with a 10-year lease. The tenant has been consistent. Here, he provided us some guarantees. Here's their business. They're already been active. They're already seasoned. Can we do a cash out refi? So the bank looks at it. They're like, yeah,
sure.
They say, what's the rent on the property? Well, like the rent on the property is 60,000 plus triple net. So the bank says, okay, at a cap 6, a capitalization rate of 6%, $60,000 divided by 6%, your property now is worth $1 million. Me as the bank, I'm willing to give you up to 70% loan on this property. So the bank give us a cash out refi of 700,000. So here we go. We we buy the property 600. A year and a half later, we do a cash out refi of 700. And now the the tenant is paying the mortgage, and the mortgage is servicing. The tenant is paying us the rent, and the rent is servicing the mortgage. And we pretty much got our money, and now we have an infinite return. Basically, you have a property that's actually cash flowing, and this is the time when we actually have the option to go and sell it.
Yeah.
And if you sell it, it's another way. What we used to do is go back to this restaurant and say, hey, you seem to be a good guy. What if we set you up with small business bank, and there are special loans for restaurant owners to own the property? What if we set you up and you can actually buy this back for yourself? And that's another exit strategy we could go if we didn't want to do a cash out refi. But that's what I really enjoyed actually. Is working on these interesting deals, and they are definitely very cash heavy in the sense there's no loaning up front. But then it's very streamlined in the sense it's like, okay, here's my input and here's my output. Here's this is how I'm going to get in. This is what I'm expected to get out, and that's what made exit strategy. But I'll tell you, not every time it ended that way. Me and my partner in 2021, during COVID, actually, no, actually in 2020, in August of 2020, during COVID, we acquired a property, and literally 6 months later, a developer came and bought it from us for
Oh, wow.
50% more, for
Wow.
50% more. And we found out later he was actually buying it to knock down the building because he had a contract with Popeyes.
Oh, wow.
But we didn't care because we bought it 50% more,
Yeah.
sell it for 6 months later at 50% more. So everybody's happy. Everybody made money. So yeah, that's kind of what we do on the active side uh, for the commercial real estate.
And BD, you also have a great fund of funds model. Can you tell us a little bit about how that transpired along the way and how that kind of works as a companion to your retail operation stuff?
Great question, Doug. I love it. So, like I mentioned, it started in the syndication early on, and a lot of people were kind of asking me, "Is like, hey, can you tell us where's your next deal that you want to invest in, so we can invest in the same deal?" And just as an LP investor. So then one of the GPs came to me and he's like, "Hey, why don't you guys, go in and structure yourself into a fund, a 506c fund, and now you can just group the capital and invest it directly under that LLC or under that entity." And that's exactly what we did. So we structured our fund, and our fund is a customized fund. We're working with a company called Avestor,
Sure.
and uh, and these guys are awesome. And it basically allows different people to join at the fund at different points in time, uh, and not every person have to get into the same deals. Like let's say we bring in 5 deals this year. You can get into 3 deals, you can get into 2 deals, you can get into 1 deal, or you can get into no deal. You say, you know what, I'm going to sit all these deals out. But the actual software from Avister will track which investors in the fund invested in which deals. So as the return starts to come in, it actually calculates everything on a pro rata share for them.
Mm-hmm.
So the beauty about this fund of fund model is uh, we're getting a lot of traction from, I'm going to say, Silicon Valley tech executives, people from my past career that still work in tech. They start to see the value of passive investing and the value of kind of building, depreciation, especially if their wife is a real estate professional, because they can significantly cut down on their taxes, and kind of come in, invest passively, and get kind of all the benefit of the return as well as the depreciation, because everything is passed through. I'll tell you, at some point when I was invested in like 10 or 12 different syndications, it was a nightmare to collect 12 different
Oh, man.
K1s
No
to send it to
kidding.
my CPA to do my taxes.
Yeah. No
It
kidding.
was it was a bit of a nightmare. And that's kind of one thing that a lot of our investors value in our fund, because you could be investing in 10 deals, but at the end of the day, you're getting a single K1 that's adjusted for your own self for all the deals that you're invested in. So that's really the value. The value for investors who want to invest passively into these commercial deals. We take the deals, we screen them, we look at operators, we look at track record, we look at specific markets. But let's just say, like, out of 10 deals, we might consider one. We're extremely picky in terms of the criteria that we would look for. And then above and beyond that, we actually negotiate for preferred return for our
Mm.
investors. So if for example, if a deal is providing a 6% preferred return and a 70-30 split, we might actually be, because we're writing a much bigger check on behalf of our investors, we might be able to negotiate to 8% preferred return and a 75-25 split. So that basically allows the investor, give them the leverage that they cannot get if they invest individually on their own. They always feel much better because they're investing in vetted deals. Nobody would have to have the panic that I had to do the first time I invested in syndication. And for them, they don't deal with the nightmare of the K1s, because at the end of the day, it's like glove service.
Yeah.
They get a single K1 from the fund that already has balance between whatever money they got in versus whatever depreciation they had. It nets things out and ships them a single K1.
That's incredible. And it seems like that's a really a turnkey service for the LPs. It sounds like a really nice package.
It is, and I'm going to say again, enabled by investor.
Yeah.
Or
Investor is a good product for sure.
Good, definitely good product, and it met
Absolutely.
a lot what we're looking for.
Yeah.
And the beauty is, these investors in my fund, we already have trust. The moment I get another active deal, like another QSR or another commercial building we want to acquire and flip, they're usually my immediate go-to to say, hey, I have a deal, here's the deal. And the beauty, they don't have to sign new paperwork, they don't have to sign new PPMs, they don't need to sign a whole lot of stuff. That's the beauty. They literally go in the software and they do click through agreements, and it's done. It's really
very
very,
nice, very streamlined. Yeah.
They're busy tech professionals. I understand what their life is, and when I was working in their life, I tell you, I had to steal time to be able to look at my real estate stuff. So it's definitely makes it a lot more streamlined.
Well, and that's what's great about this too is BD, you really know the customer pain points, and so you live their life. So you're definitely able to completely get to the light of the heart of the matter, what they need from you, and I think that's incredible.
Absolutely, and again, it started by a lot of them being, friends that already know me at a personal level in tech. And now we're just meeting a lot more new investors. They just find out or they hear from other people. And we're trying to do more marketing to really get the word out. I think a lot of people are, especially in tech, we are very weighted in terms of our overall capital in the stock, because the company you're working at is giving you stocks, your 401ks and stocks, everything is stock. So a lot of people do panic, especially in times like this. And they're like, hey, can I diversify? Can I shift things out? And you'll be surprised. So many of those investors, they don't really know that you can invest your older 401k into real estate. It comes to them as a shock.
Thank you so much
like,
for making that point too. I think that's one of my almost like my mission in life is to educate people on the power of rolling your 401k over into either a self-directed or a solo K, depending on what your objectives are. And it's such a powerful tool.
Incredible tool. And I'll tell you, I had 2 or 3 other investors that came in early on in the fund, and all of them have solo K. And right now they absolutely love it. When they understand the value and how it works, they're like, oh my God, this is an incredible vehicle. And a lot of them right now, actually one of them, he asked his wife to retire because she can work on the real estate and they can become a real estate professional and help them out on their taxes. So it's really, in some sense for me, I stumbled across a lot of learning over time. And big part of my mission that I feel is for people like me, they were in tech.
Yeah.
I can really showcase them a lot of things that probably you're not seeing day to day. I mean, the most you hear about in tech about 401k is when HR runs this thing and says, oh, you got to invest into 401k. You have no idea what your 401k is or how well it's doing. As a matter of fact, I wrote a whole paper on it after I tracked my 401k from 2009 to 2019.
Yeah.
And I found out that my portfolio did not even do no, actually, it did 25% what the actual S&P 500 did.
Hmm.
So if the S&P 500 did 2x, my portfolio did quarter of that,
Oh
0.5x.
man.
Yeah.
And I
And
wish that were a unique case, but I hate to say it, but average 401k portfolios are not usually that great. And worse yet, and this is where the real crime comes into play. I think it's an underrated problem, but I think the fees that they charge, for underperformance is. I don't mind, paying for like, outsized performance, but unfortunately, a lot of times like that, you're paying, reasonable, really high prices for underperformance. So it's like, what are we even doing here?
absolutely. And I'll tell you, I totally get it. People in tech, they look at it as like, hey, I'm just gonna put money into 401k because it helps me cut down taxes.
Yeah,
I'll deal with it later. And they're not really thinking about it as like, oh my God, that's my money. I should be investing it the right way. And you know, when you start realizing it's like, oh my God, either you control that bull or it's gonna come at you,
yeah,
and it's like, no, I'd rather ride the bull and control where it's going and
that's
have
right.
it consistently generate return. I still prefer to invest my cash into real estate because I can get the depreciation.
Yeah,
Unfortunately, when you invest it into your 401k, you're not going to get the benefit if you put it into real estate from a depreciation standpoint.
right.
But again, there's a whole lot of other tricks in the bags that I've learned over time, just by mingling with you and a
Yeah.
whole lot of people in this domain. There's just so much knowledge out there, and
And to that
I think
point,
more and more people should really start to learn that kind of knowledge.
we are trying to customize our setup. We like car washes for active income for depreciation. And right now we're really excited about the debt opportunities for retirement funds because the debt stuff in retirement funds is really nice. It just sits there and percolates nice income over tax deferred, and it can really accelerate compounding just by sitting there tax deferred like that. So depending on the vehicle and what your goals are, what asset class makes sense. And it's such an incredible mission, and it feels so satisfying to talk about this stuff. And BD, that's part of why I'm excited to have you on the podcast, because I know you're out there preaching the good word, as we like to say, and really impressed with what you're doing. And to that point, you really did open my eyes again. I really haven't paid enough attention to this, and we just talked about this recently. Can you talk a little bit about the power of being a real estate professional and how you get that done?
Yeah, so again, it's not a specific training or a designation. It's purely a classification based on tax code, IRS tax code. You probably want to have more a CPA tell you a little bit more about it, but this is what my CPA told me. Is like you have to spend 750 hours a year in the profession of real estate with material participation. Um, and now, once you meet those 10 level criteria, any depreciation that you get on your real estate investing, you can subtract it from your active income. And I didn't understand it initially, but when I started diving understanding taxes, you have earned income, which is active income, and you have like passive income, which is income that you get from an investment property. These are taxed at a completely different rates. So active income is taxed at a much higher rates versus passive income is usually taxed at 50, 0, 15, or 20%, I believe, at the federal level. Don't get me started about California. That's a whole different
Oof, oof.
that's a whole different animal.
Yes.
But um, that being said, imagine you and your spouse are earning $300,000 a year in active income, roughly living in California. You're really talking about your tax is going to be close to half. So 150K a year gets taken out of your, and you're left with 150K, just to
Mm-hmm.
make the math easy. Now, all of a sudden, let's say that you've invested into commercial real estate passively, and you got some depreciation, and let's say you had $200,000 of depreciation in 1 year. Your wife is a real estate professional. You don't have to be a real estate professional. Only one of you has to be. Now, all of a sudden, your active income is 300,000, but your depreciation is 200,000. So that's negative 200. So now it makes your net taxable income of 100,000. And let me tell you, now if your income is 100,000, your taxes are about 30K. So now you're only paying 30K in taxes instead of $150,000 in taxes. So it becomes a huge thing
Mhm.
when one of you can become a real estate professional and you're passively investing in real estate and getting that benefit of the depreciation because you get to use that against active income. Let's say in the case that your wife is not neither one of you is, both of you have W-2 jobs and both of you work in tech, or she's a doctor and you're work in tech. Now you cannot use all that depreciation that you have against active income. You can only use it to offset income that you get from rentals. Um, but again, CPAs can usually walk people through the detail of what works and what not work. But I'll tell you, having a high income on one side and being able to be real estate professional status on the other side, and investing in commercial real estate and getting the depreciation is the trifecta that I see out there. Is like high income, low tax, significant amount of benefit that you can get, out of this.
And BD, I'm going to join you with you on this, educational mission because I really am inspired by the way you explain it and the power of it. And I thank you so much for everything you've taught me so far. I've really learned so much from you. Every time we talk, I'm like, man, I learned something from BD every time we talk, and I really appreciate that so much.
Yeah, thank you, Doug. Likewise, it's always being in the same room and in the same crowd, and it's always fun to be here. I definitely appreciate your time, and hopefully one day you can come and pick me up in your Cessna.
I would love nothing more than to take you flying in the Cessna when we get out to California. I would love to do that. Well, BD, thank you
Absolutely.
so much for the time today. What is the best way to get a hold of you? They'd like to know more about what your opportunities are.
Yeah, no, absolutely. I would say, our website. I mean, I'm available on LinkedIn as well. But I would say our website is bfi-fund.com, as in Bluestone Flagship Investors, bfi-fund.com.
And we
If you
will put
go
that in the show notes too.
And then if they go /webinar or /consultation, they can set up time in the calendar and talk. And like I said, we're here to talk to everybody. We really enjoy this stuff, just like you enjoy it and I enjoy it. I love teaching more people about it. And I think the more people they know about it, the better everybody else gets.
I couldn't agree more. It's such an incredible way of, leveling the playing field. Wall Street strategies for Main Street is what I like to say. It's such an incredible opportunity, and BD, you're doing such great work in terms of spreading the word and helping people out, and that's just such a high calling, and you've just really have been impressed with your resume and what you're doing. It's just so fun to watch.
Appreciate it, Doug. Thank you very much. And definitely, I continue enjoying this journey every week and for more times to come.
I look forward to speaking with you in the future about it. Thank you, BD.
Thank you.
All right. Bye bye. All right.